answering your tough financial questions for the past 26 years. It's Allworth's Money Matters with co-hosts Scott Hanson and Pat McClain. Would you like an opinion on a financial matter you're dealing with? Whether it's about retirement, investments, taxes, or 401ks, Scott Hanson and Pat McClain would like to help you by answering your call. To join Allworth's Money Matters, call now at 833-99-WORTH. That's 833-99-WORTH.
Welcome to Allworth's Money Matters. I'm Scott Hanson.
I'm Pat McClain.
Thanks for being part of our program today. Both myself and my co-host here. We're both financial advisors. By the way, before you change the dial, because we say we're financial advisors.
Yes. We're not selling life insurance or big fat annuities or any of that.
Online trading programs.
None of that. We're just trying to actually take your calls, questions, and see if we can help. If you'd like to join the show, 833-99-WORTH. That's 833-99-6784.
Yeah.
And you can join us on our show.
Yeah, and we're going to take quite a few calls today, and so we are looking forward to...
We deal mostly around, we can answer any questions you have, we'll try to answer any questions you have regarding money, but what we will, most of our questions are regarding retirement planning, that sort of thing.
And I tell you, it's been such a bizarre year for the stock market. But bizarre year all around. I mean, obviously, but we saw the market just looked like for a while it was just going up, up, up. I mean, the month of August was like
crazy.
Broad markets, what 7% or something for the month? It was
crazy.
Yeah.
Think back about this when the whole pandemic started, and how people were reacting to the markets, and how the recovery just took place so fast. It's mind-boggling. Don't you find it a little bit interesting how quickly the recovery took place? Not the economy, the recovery, the stock market.
I know, not the economy.
Not the economy.
There's still a lot of unknowns in the economy.
A lot of unknowns.
Because there's a lot of unknowns on the
And there's many theories as to why the stock market recovered so quickly. And I have my own theories. One is the Fed stepped in and helped liquidity in the bond markets. The other is that there was a lack of alternatives, online trading, people actually not being able to leave their houses and then unable to engage in anything other than stock trading.
Well, stock trading, and we're going to take quite a bit of calls today. So 833-99-WORTH is the number to be part of the program. If you want to call and schedule time to record with us, it would be great. 833-99-WORTH, because we find our calls fascinating. And I hope you do as well. But if you look at the number of online trades that are going on, and options in particular,
for the uninitiated, what is an option?
It gives someone the right to either buy or the right to sell a stock or any other item for that matter at a predetermined price. And to think of this back in the early days of farming. And let's say you were growing corn and you didn't know what the corn, if you had a huge crop and so did all your neighbors, that was bad because too much corn, the price would go down.
And not enough corn, the price would go up. But you're planting the corn and you're a farmer and you're trying to isolate yourself from that risk of the price.
So you shift the risk using some sort of option, perhaps, right? Like I'm going to have the right to sell my corn at X dollars come harvest time.
Regardless of what the market price is at that particular time. So that's the genesis of how options actually came into being and how they're used. And it has moved to other asset classes above that of commodities.
And so right now, options, the use of options by individual investors is staggering. The options markets are up almost double from where they were a year ago, 92% higher than a year ago. And part of this is because of these online trading apps like Robinhood.
There's a couple of them out there.
I mean, that's driving a lot of it. Novice investors don't understand that you can lose big too.
And the cost of actually trading has come down significantly. So to do a transaction, which used to cost $50, $100, $200, years ago, now pennies.
By the way, this will not end well for most individual investors. If you are out there trading a bunch of options, thinking this is how you're going to get wealthy, it will not end well.
It won't end well. That is
It just doesn't. Options are zero sum.
It does end for most people. And most things don't end well or they wouldn't end.
That's
the nature of it.
We said we're going to take quite a few calls. So let's go hit the calls here. We're going to talk with Lisa. Lisa, you're with Allworth's Money Matters.
Hello. First, I'd like to thank you so much for your ministry. I've been following you guys and following your advice for, I don't know, probably 20 years now.
Well, thank you.
Thank you. I never thought of myself much as a minister, but stand a little taller now.
It's a wonderful ministry, that is for sure. But my question is about my son. He has been working. He's 16, and he's a sophomore in high school. And he's been working for years to earn money, different things here and there. And he now has $8,000 in an Orange ING account, and he will soon have around $30,000 in a 529. He plans to attend a local college, and it's about $10,000 a year and live at home. So we're looking at maybe $40,000 for his college expenses. And so my question is, with the $30,000 in a 529, would you? I feel like maybe I should stop putting money in there and put it in something different. And is that what you would recommend? And what would you recommend?
How much are you putting in?
Well, he bought a dog, a miniature golden doodle, about 4 years ago, and he has bred it occasionally. So whenever he has a litter of puppies, he makes about $15,000.
15 grand?
Yeah.
Really?
Yeah.
I'm in the wrong business.
Has he done this yet?
Yeah, he's had 3 litters, I think, 2 or 3.
Okay. All right.
2.
Oh, yeah, I'd quit saving for his college.
Yeah, I'd quit saving.
Seriously.
I actually
Okay.
would. I'd
And
ask
what
him.
would you do
I'd
with
ask him to move out now because he's that responsible.
He's only 16.
It's okay.
How many
Listen.
kids do you have, Lisa?
What's that?
How many children do you have?
6.
Do you really?
Oh, my
And he's
goodness.
the oldest.
Wow.
But this is money, that he's earned on his own. So it's not really money that my husband and I are.
No, I
We're
understand.
helping him, obviously.
And have you funded all 6 of the kids' 529 plans?
He's my oldest, and so he's the first. My daughter is doing the same thing.
But
So
do you
we're
have money?
working on it.
Do you have money
Yeah.
in all 6 children's 529 plans?
The top 5.
Okay, so let's explain why you may want to actually continue to fund that 529 or the 6th child that doesn't actually have money in the 529. You can move money from one 529 plan to the other 529 plan without penalty.
Okay.
I should say that wrong. You can't move it, but you could change the beneficiary once a year, which means you could put all of this money in your oldest son account, right? Thurston Howell III. You could put it all in his account. And then when he gets through with his 4 years of college, 5 years of college, depending upon how long it takes him, and he doesn't use any, you can actually change the beneficiary to the youngest child.
Okay.
Or any child.
Or any child. So
Let me ask you
a
this.
child can
And that-
have more than one 529 plan.
Okay, and I guess what I'm thinking with that is because this is money that he has, earned himself. I would just read him.
What money are we talking about? You're what are you? Is the question what to do with his $15,000 he earned? Because I thought the question was about you contributing to his college savings.
No. My husband and I don't put any money in from us. It's money that he's earned.
Oh, the 529 is all his.
Yeah.
Oh,
Yeah.
Oh my gosh.
yeah, but he's 16, so that what you're doing, the 529 is for tax benefit of tax deferred growth, and he's not going
I'm
to put
wondering if
any money at risk.
maybe we should do like a Roth
Roth.
for him.
Yes.
Absolutely.
Yes,
If
a
I
Roth.
should-
Yeah.
Yes.
100%.
Like for the money that he is earning.
Well,
Is that
you
should
what
do the
would
maximum of
at
the
this
Roth.
point,
But he's
or-
not paying taxes on it. This
something
is
different?
That's why a Roth. Oh, is this money claimed on income taxes? or you not claiming it?
I think.
Are you being legit?
No, we are not claiming it.
Okay,
on
yeah, the Roth
our
doesn't
income
work.
taxes.
Does he file in his own tax return? Does the government
No.
know that your son is raising labradoodles and selling them in the black market?
Golden doodles
I'm sorry.
in the
Gold.
black market.
Well, if you're not claiming it, I mean, I hate to say it,
It's the black market.
but if you call those ministers early on, I'd be like, you might want to.
So here's the answer to the question is, he should not put any more money into the 529. He's not eligible to put money into a Roth.
Unless the income is claimed.
He could put money in the 529, but the only reason you're putting money in the 529 is for tax deferral benefit. He's got 2 years to go before he starts using the money. I would just put it into that. You said he had an Orange ING account. I would just put any of the earnings in there.
8,000.
Yes, correct.
Okay.
Just have him add to that. So any of the money he makes off selling these golden doodles, labradoodles, have him
Right.
take that money and put him in the Orange ING account, and the 529 is it's fine. It's fine.
Let me just clarify. My husband does the taxes. I'm not sure how he does that. We report everything that we make. I don't want to make it sound like we're.
I understand. My guess is that your son is not probably keeping track of his expenses.
We have dogs of our own, so we do have.
Okay.
We all have. We have like four that my husband and I own. So we do have a business that we report everything that's coming and going, all the expenses.
If your son is recognizing this as ordinary income
And files a tax return.
then fund the Roth IRA. If he is not,
That's what you would do. Okay.
Yes.
if he is
Roth
not,
IRA.
then put the money in the ING account, the Orange ING account. All righty?
Okay. All right.
And
well, thank you very
have
much. I
him
appreciate it.
have all the other 5 kids follow along just like this in this entrepreneurial spirit of your son.
Yeah,
Absolutely.
Well, it's easy because we have this as a little side business that we do. So
Oh, good.
That's-
Good for
it
them.
just
And
sort of falls right in line pretty
Sounds-
easily.
All right. Well,
Great.
appreciate the call.
yeah, thank you, Lisa.
Yeah. Okay. Thank you. Bye-bye.
And we're heading next talking with Boz. Boz, you're with Allworth Money Matters.
Thanks, guys, for taking my call. My question is really about my parents, and I'm trying to understand a bit more around Social Security because the website is explicitly clear on every single option. So my parents have about an 8-year age gap. My father is 70. My mother will be turning 62 early next year. He took Social Security early at 62. And given her age, her full retirement would be at 66 in several months. Considering he started his Social Security benefit early, if she decides to take the spousal benefit, is it 50% of his benefit at the time she files, or what would have been his primary insurance?
No, it's dinged because he took it early.
Okay, so it's 50% of, if she files next year, it's whatever his amount would be for next year.
Well, she'll receive the higher of either her own benefit or the spousal benefit. It
Right.
used to be you can play some other little games, but you can't anymore. So it's automatically going to be either whatever's greater, either her benefit or 50% of his benefit.
And which one is that? Is her benefit going to be higher than 50% of his benefit?
Well, so currently his gross benefit is $1,600, and then there's the Medicare deduction and such.
Right.
Yeah.
At full retirement age, her benefit would be $1,000 a month.
Uh-huh.
But if she takes it at 62, her benefit would be about $650.
And is she still working or retired?
She's still working, so I know there's a reduction for
It's
any amount
a huge
over
reduction.
$18,000.
Yeah. There's no point in, if she's still working, you shouldn't even consider it until she gets full retirement age. If she's still working and making, I don't know what the limit is.
It sounds like it sounds like they don't have a lot of money saved, my guess.
They have about $450,000 saved in retirement accounts.
And is their home paid for?
No, they have a small mortgage left, about $85,000.
And do they have money in the bank?
Yeah, they have about $40,000.
Okay. So
they're refinancing their mortgage right now. So they paid off a bunch and then refinanced to a 20-year.
okay.
And lower rate.
But you shouldn't even consider Social Security if she's making
They did a
over
20-year or 30-year?
The new mortgage is 20 years at 3%.
If it were my mom, I'd be arguing for a 30-year, just to tell you, because
Yeah, if you're in the
Lower
process, ask for a 30-year just to get the payments as low as possible.
Yeah.
It's
sense.
never
not
going to
gonna
get
make
paid
it's
off.
a small mortgage. It's not that big a deal.
Yeah, but it's still she's not going to. They're not going to. Your mom's going to have the mortgage paid off when she's 82, so you could fly first class. But you shouldn't even consider Social Security if she's still working.
Yeah, you can't get it. It doesn't make any sense at all.
It makes no sense
until
at all.
she's sick, until she reaches her full retirement age.
Which is for 66 in a couple months.
Yeah.
Right.
All right.
Okay. So even though her total, I mean, she doesn't make that much. She makes about
What does she make?
$25,000 a year.
That's
Right.
over the limit.
25 a year.
Yeah, that's over the limit.
Yeah. So it's she would lose out about $3,500 a year.
Not only that, I mean,
But
this is not going to be an insignificant amount of her pay. I mean,
Yeah.
yeah,
she's going to need the Social Security as time goes on.
yeah. So don't
So the longer she can wait, the better.
don't do anything until she retires. All righty.
Okay.
All right.
Great. Thanks
All
a
right,
lot,
bud.
guys.
Appreciate
All right.
the call. Thanks.
And we didn't get into survivor's benefit. Probably be greater than her benefit sometime down the road. But
At some point in time.
yeah. Anyway, glad you called. Let's continue with our calls. Talking with Bob. Bob, you're with Allworth's Money Matters.
Hello, Pat and Scott. Thanks for taking my call.
Thanks, Bob.
I recently started listening to your podcast, and it's very interesting and knowledgeable.
Thank you.
Yeah. My question is, I have about $200,000 in I bonds, which I bought in 2002, and they're paying about 5% interest at the moment.
You look brilliant.
Thank you. I'd like to know, should I cash them out over the next few years, or can I leave them to my beneficiaries?
And what other assets do you have outside of that? Do you have any equity exposure, stock exposure anywhere?
I have about $2.7 million in investments.
I would not do anything with these I bonds. They're going to pay interest for 30 years.
And I would leave them to my heirs.
Okay.
Or, I mean, if you needed to spend them at that point. But these, when you got a 5% interest with a guaranteed inflation adjustment on it, you can't buy these today.
You can't.
Matter
you're right.
of fact, if you wanted out of them, there would be somebody who would be willing to enter into a financial transaction with you to you can't transfer these are savings bonds. You can't transfer a savings bond with one person to another. But for example, Bob, if you were a friend of mine and you want to get out of these, I might say, I'll tell you what, Bob, I'll make you a deal. I'll pay you $220 or whatever the number is.
Some premium.
Yeah, because if these were publicly traded bonds, it would be worth a whole lot more than $200,000.
Yeah.
Okay.
No, you're brilliant.
So if I leave this to my beneficiaries, they can just hold them. If I want to pass away, say tomorrow, if I leave them to my beneficiaries, can they hold them, or do they cash them out?
You can just list your kids as beneficiaries, and it'll transfer directly to them at your death. So it makes it nice and clean and simple. So do not cash these bonds in
Don't
right now.
cash them out and plan on your family inheriting them.
That's right. So appreciate the call. And let's now talk with Jack. Jack, thanks for being part of Allworth Money Matters.
Hi. So I live here in the Bay Area. I plan to retire in 2 years at 63. I'm pretty well set in terms of I've been saving along with my 403B and my pension. I should be in around 6.5 to 7K per month from the pension and 403.
Okay.
I have a few small accounts, not much money, but then I have a big account where I've been saving money because I had paid my mortgage off a few years ago.
Good for you.
So I've been saving some money from the entire lifetime, and I have about $350K that I've put basically 95% in equities because it's money I can risk. It's sort of my play money.
Okay.
So I'm wondering if I should diversify into real estate because people are telling me, hey, well, not after the past couple of months, but before that, people were saying, hey, maybe you should get a property
So,
and invest there.
how much do you have in your 403b?
403B, close to $1 million.
And what percentage were you taking out of that in order to make up the $6,000 to $7,000 a month in addition to your pension?
There's calculators I did, and I did a projection. So I don't remember the exact breakdown between the pension and the. It's
But
about
was it-
even, I think.
Was it less than 3%?
I don't know the percentage. It's probably
Okay.
4 or 5%.
Okay.
4% probably.
Okay. So the question is, should you own real estate investments? Have you ever owned real estate investments before?
No, and I'm not that comfortable. But people
Then-
are saying, yeah, you've got money, you've got cash, you should do that.
I think that's
Yeah,
a
I
terrible
I
idea.
have enough for retirement.
I think it's a
I have
terrible
enough
idea.
for retirement.
I think it's a terrible idea for you. You have no experience in it.
You don't need
You're
it.
going into retirement. It would require the use of leverage, most likely, which is you're going to either have to take a loan of it or sell your equities, of which you have 95% of this $350,000 invested in. You don't need it. It would add complexity to your life that would add hopefully economic value, but not certainly.
And the reality is, you're only going to get rising real estate prices if we have a growing economy in California. The stock market's, I mean, that they're going to have the same, and your stock prices are not going to go up unless we have a growing economy. Anywhere, though, frankly, not just tied to California. So,
But one of the reasons real estate may make sense for some investors, which they normally don't talk about, is they use leverage, which is
And-
they take a loan out.
and their own time.
Correct. And remember, leverage is a lever. It's a lever, and levers go both up and down. So people lose all of their money because they lever too much or they use too much leverage.
The
But he
fact
doesn't. You don't
the fact
need
is
it.
you don't need it. So
You've achieved
you're
your
taking about
objective.
3% out of your 401k, and you know the $350,000 you're not touching.
Home's paid
your
for.
Your home is paid off.
I wouldn't complicate
Paid
life.
off.
Yeah. Wait.
Oh yeah.
By the way, there's never been a 15-year period where stocks have not outperformed bonds or real estate.
So I wouldn't mess with
If you
that.
go out long enough, short term, the thing about the stock market that's frustrating is is you can see the prices every day, every minute. You wake up and you're looking at what's going to happen at
And J-
9:30
And Jack,
Eastern. And
by the way, those people that are probably telling you to buy real estate probably don't have $1 million in their 403b.
yeah, I guarantee they don't.
No, I wouldn't.
guarantee it.
Am I allowed another question?
Sure.
Yeah.
So this would be post-retirement. So looking at the buckets I have my pension from my company, which I'm pretty sure is going to be around. I have my 403. I will have Social Security, and I have this bucket of money that I call my play money. When I retire, which should I draw out of first for tax purposes and also for? I heard that if I with delay withdrawing certainly from Social Security, my payments will be larger later. Or if I even delay taking.
So
my
here's
pension,
where,
not my pension.
yeah, this is a great question.
Are you married?
I am single. I'm probably not expecting to be married.
Okay, and so you're retiring. I'm guessing somewhere in the it's from a medical field.
Or nonprofit education.
Correct. Nonprofit.
Okay.
You've got there's a lot of planning so you've got a lot of options before you reach age 72, when they tell you how much you have to take from your 403b, you've got a lot of planning opportunities. And it might be that in the first couple of years, you spend down some of what you've called your play money, and at the same time convert some of that 403b to a Roth IRA to lock in some tax rates.
And defer Social Security. It depends on how much your pension is versus how much of
But
a
there's a lot of
distribution
planning.
by the 403b.
It's much more complex than
A radio show.
yeah.
I got it. Yeah.
But you are your
You're good,
situation. It is ripe with opportunity.
Yeah, you
by
got a
the
lot
way.
of good planning opportunity.
It is ripe with opportunity because you could look at this and you'd say, well, I don't really want to sell any of that $350,000 to pay taxes on the conversion from my 403 to a Roth IRA because you have it in equities, but we could replicate the equities inside the 403b or IRA and defer Social Security, assuming you have a normal life expectancy. There are so many planning opportunities here because you've got it in all these different buckets. Whether you planned it that way or didn't plan it that way, you've got it that way. And the
It
different
is that way, and it was partly planned,
perfect.
partly just following advice from everybody. Because I do listen to you guys, and I also listen to other people, and I try to find out what makes sense. But,
Perfect. You might want to pay an advisor for a financial plan, whether they manage the money for you
Yeah.
or not.
I
Pay
agree with
them
you on.
whatever the fee is for a financial plan, and then decide whether you want to hire them to manage the money. They're can be two separate different issues. So appreciate the call.
Glad you called, Jack. We're going to take a quick break coming up here in just a moment, but I want to remind you, if you haven't been on our website in a while, easy for me to say, Allworth Financial, there's lots of great tools. We've got a learning library to help on a variety of different retirement
And
topics.
a personalized learning platform, which actually gives you customized content based upon what you're interested in. So you answer
Yeah.
a few questions, and then we lay out a library of what you should read.
And
based
you can
upon-
sign up for our weekly newsletter that's delivered every Saturday. But we got to take a quick break. Stick around for more Allworth's Money Matters.
Can't get enough of Allworth's Money Matters? Visit allworthfinancial.com/radio to listen to the Money Matters podcast.
Welcome back to Allworth's Money Matters. Scott Hansen.
Pat McLean, thanks for sticking with us.
If you want to be part of the program, we'd love to take your call, 833-99-WORTH. And there's one thing, many of us have been working from home, as have I for most of the last 6 months.
As I have as well.
And I noticed REI had built some really cool looking, I don't know if you read any of these articles, a really cool looking headquarters in Washington, designed just like you would imagine what REI, the sports, outdoor sports retailer would build. It was their headquarters. It's their office headquarters. And they decided not to move into it, and they just sold it. Facebook decided to buy it, which I thought was a little interesting. But REI thought, we're just going to stick with remote workers.
Yes. And obviously a different business too. It wasn't just remote workers. It's that they probably realized that going forward, they did not only need the campus, they probably couldn't afford it. And quite frankly, I was a little disturbed that they built that nice of a campus to begin with.
Because they're a co-op and you are a member.
And I am a member.
Okay. I thought the same thing. My dividend check's going to be a little smaller.
Which is the same thing.
Because I like REI.
But the same thing I felt, I'm from Sacramento, and we have the Sacramento Kings and the Golden One Arena, which, by the way, is a credit union that can only operate in a certain region, but I've been a member of the Golden One for
that
30
still bugs
years.
you?
Yes, it absolutely bugs me. Why couldn't you just give a higher dividend to the existing rather than buy a national platform advertising, which is what a stadium...
They're serving the community, Pat. It's a community service.
Someone in Boston that sees the Golden One can't sign up for the Golden One.
I think they can. Aren't there much looser now? Restrictions on
maybe I don't know what I'm talking about. I apologize to everyone at the Golden One. It just didn't seem like a very good use of money to me. And I am a member.
Maybe I don't know what I'm talking about. But fortunately, Pat knows what he's talking about. We're talking about financial planning issues.
Thank you.
But I think we are seeing it'll be interesting to see what ends up happening with real estate prices over the next 6 months, 12 months, 24 months, both on commercial property, office buildings, as well as residential. Because people are starting to move.
It's a reallocation of resources from both a corporate and individual level. So I came across this interesting article, Stripe, which is based primarily in Seattle, but they have offices, offices, not the beer, Seattle, New York, and the Bay Area. And they do payment processing, 2,500 to 3,000 employees. Not a huge company, but they're paying their employees $20,000 if they move out of New York, Seattle, or the San Francisco Bay Area and take a 10% reduction in pay. You think, well, why would someone take a 10% reduction in pay?
You know how expensive it is to live in those cities?
That's right. And so
you got to pay to have your car parked somewhere, right? You got to pay.
You move to Boise, Idaho, you're net ahead.
Austin, Texas. There's a lot of...
Yeah. As I mentioned last week, Winnemucca, Nevada. Any of these places where the cost of living is lower, and it makes economic sense for the company to offer the $20,000 in the relocation fee. But it will be interesting to see where this all ends.
And you see the resort towns, the real estate prices are going through the roof.
across the U.S.
Yeah. All right. Let's take some calls. 833-99-WORTH. We're Northern California with Dio. Dio, you're with Allworth's Money Matters.
Good evening, sir. Yeah, my name is Dio Sharma. I appreciate your show. Long-time listener, first-time caller. I have a question about my retirement. I'm 54 years old, looking forward to retiring in 6 years. I got a 401k, 403b, work for the medical center in Sacramento. My question was, I got about $400,000 saved up in my 401k and 403b combined with some rental properties, 3 of them. Got the rental income coming up to about $3,000 a month. My question was to see if there is any other annuity that I could buy to get extra income post 60, considering the current situation.
Yeah. So, I mean, if you wanted to exchange some cash for a guaranteed interest, the challenge is in today's environment, the interest rates are so low. You would basically saying, I'm comfortable with locking money in for the rest of my life at 2% interest.
Oh, okay.
That's what I mean.
And quite frankly, you have quasi annuities with those rental incomes, so it's not.
I would work on getting those paid off, or at least paid way down.
Before I would buy an annuity. Do you have any debt on the rentals?
Yes, I do. I have a mortgage of $90,000 on one and about $125,000 on the other one.
Okay, and do
the
you
third
have
one is paid off?
Do you have any? So you've got about $225,000. Do you have any liquid cash right now, like money in the bank?
Yes, I do.
How much do you have?
Yes, about $100,000.
So, and do you have designs for that? Are you holding them for something?
Well, that's like an emergency fund for 6 months.
What do you owe on your primary residence?
About $170,000.
And what's the interest rate on that?
It's at 3.0%.
Okay. So I would look at taking at least part of that $100,000. Remember, you've got a 403b, and you can borrow up to $50,000 out of that 403b if worse comes to worse. I would redeploy some of the income directly against that debt on the rental properties, and then I would re-amortize that to see if I could pay those things off in the next 6 years prior to your retirement.
I'd focus on getting all the debts paid off.
In terms of...
Are you maximizing your 401k, 403b?
No, I'm contributing 25%.
Of your pay?
Correct.
You're doing pretty good there. Right now, you may not have an annuity option in your 403b or 401k by the time you retire, it will most likely to have an annuity option because of the change in the legislation.
I think you're doing a pretty good shape.
I think you're doing a great job.
Yeah. I mean, you could probably have a little more in your 401k, but you've got the rentals.
I think he's doing a great job.
You've saved there.
Yeah, so I would take $75,000, maybe $50,000, and put it against the debt on the rentals, and then see if I could accelerate those rental payments or the debt on the rentals so it pays off in 6 years. But you're doing a great job. You should be proud of yourself.
Thank you very much, sir.
I don't know what else I would recommend doing now.
Okay, so as far as the owner of my own home, I'd rather pay the rentals first than my own unoccupied home.
Yeah, you're going to pay the highest cost of capital first.
Well, except the fact you get a deduction for your rental property. Are you still itemizing your deductions, or are you going to standard? You still itemize?
I'm itemizing, correct.
Yeah, and
okay.
Scott, I was going to ask, what's the cost of money on the rentals?
They are at pretty low. One of them, it's all below 4%. I got a 3.875 and 3.5.
But the cost of money on your home is 3.
Yeah.
So you want to pay the
rentals
off first.
I would look at how much, because are you single or married?
I'm married.
So you got about your standard deductions about $22,000. I would look to see how much your itemized deductions are. If they're close to that, then you're really not getting that tax deduction. And so maybe getting the primary residence paid off first would make more sense. Or refinancing the primary residence to a larger loan and then paying off the rentals.
Absolutely. All right.
Those are a couple of
great ideas. Good ideas.
Those are good ideas.
Yeah.
They're fine tuning.
Yeah.
That's just fine tuning
around the edges, but it's not going to make.
You're in good shape.
You're doing great job. Keep it up.
Great. Thank you very much, sir. Really
Thank you,
appreciate
dear.
your help.
Thanks so much. Glad you called.
Bye-bye.
Good saver.
Yep. And let's continue. Why don't we talk with Raul? Raul, you're with Allworth's Money Matters.
Had a question regarding an old universal life policy that I took out in 1987. And I almost forgot about it. But I was wondering if there's any way that I can leverage that policy as an investment. I came across a radio show where the speaker was leveraging life insurance contracts and funding the life insurance contracts right now as a means of putting together a nest egg for the future. So I wondered if that made sense from your standpoint to do something like that.
So I've heard there's lots of infomercials on radios these days talking about how to trade your money into wealth. One guy was like, he's a pastor, so I guess God's going to teach you how to trade so you can. When you trade, you're just taking zero-sum games. You're taking money from somebody else, which is always an interesting concept. I don't know why that's somehow biblical, but anyway. And then I know there's people out there that play kind of this life insurance game where
they talk about how the fact that the taxation on the life insurance that grows tax deferred, and then you take your money out tax free because tax law allows the dollars to come out. FIFO, which is first in, first out, which means you can pull your principal out and then you borrow against the rest of the contract. And then when you
tax
die,
consequences.
You never pay taxes. And this is how the Rockefellers do it. Does this story sound familiar?
That sounds very familiar.
All right, so let me back up a little further. Both Pat and myself started our careers for a couple of years with a firm that was owned by a life insurance company. So, and we would get, it's like most of the training, all it was whatever the financial problem was, retirement, college savings, whatever it was, life insurance was the solution. And they had all these complex ways of structuring things. And frankly, we both have chartered financial consultant designations, which is a financial planning designation that has a couple extra courses just on insurance contracts. So we understand this stuff so well that the vast majority of the time we think whole life insurance, universal life insurance is a waste. People are much better off with just term insurance and avoiding all those expensive contract.
Now, so there can be a place for cash value life insurance policies, but it isn't. It isn't as common as it once was because of the changes in the tax law, significant changes in the tax law, and it's relatively expensive.
So tell us
what do you have and what are you trying to do? So what's this policy worth? What's the face value on it? What's the cash value on it?
It's worth $50,000. The annual premium is $1,900, and there are a few years where I've skipped the premium, and the policy, of course, was still in effect. And so, as I mentioned, I almost forgot about it.
How much is the cash value if you cashed it in today?
Let's see. It's not very much. I think it's only about $12,000.
And you're paying $1,900 a year on this?
Well, I had been. I haven't.
How old are you?
In quite a while. I'm 69.
And are you retired?
No, but actually that leads to another question. If I can have two questions.
Yeah, let me drill a little further on this, then we'll move on.
Sure.
So here's what you have a policy that it'll pay you $50,000 at your death, and you have $12,000 cash in there. So essentially, you have $30,000 worth of life insurance that you are paying for every year. Whether or not you make your $1,900 a year premium, they're taking it. If you look at your annual statement, you can see they're taking it out of your $12,000, paying for that $38,000 of life insurance.
And they call this cost of insurance.
Yeah.
You surrender this thing tomorrow.
If you are in relatively good health, you'd be much better off going and buying a term policy for a period of time for $38,000. Odds are it's going to be less expensive than the way this universal life policy is working. For one, you bought this in 87. Most of the people who bought the policy have surrendered them by now or died. No. What happens when people are healthy?
Who keeps them?
The sick people keep them.
Sick people keep them.
So what ends up happening is these insurance companies build these things in blocks, and every year or whatever period of time, they'll issue a new contract. And so the people that are still having this, the ones that say, no way, I'm never spending this, as Pat said, they're probably the ones that aren't as healthy. So the insurance company knows that. So from a mortality table standpoint, the longer you have this, the more they're going to charge internally. So if you need life insurance and if you're in reasonably good health, this probably is not, keeping this policy is probably not the best thing going forward. But I don't want to tell you without knowing anything more about you just to cancel it because you got.
Yeah, well, my health picture isn't that great at this time. I had major surgery, and to make a long story short, it was a cancer diagnosis. So it may make sense to hang on.
Well, then keep it.
Then keep it. But you might not want to pay the premium either.
Yeah.
Right.
Just watch that cash value and down the road.
See how it goes.
Yeah.
Yeah, cash value will drop if I don't make the payment.
That's correct.
That's fine. Yeah.
Correct. In an ideal situation, the cash value will be $1 the day you die.
Mm-hmm.
Yeah.
Yeah, well, that makes sense then, and from that perspective,
right?
To hang on to it. Okay.
Yes.
So you had another question for us.
Yes, it's actually more of a personal question, but as I mentioned, I'm 69. I'm on a leave of absence from work right now. I have a projected Social Security amount that will be effective when I hit 70 in October. So my question was, if I continue working, will that number continue to go up, or is that fixed?
Yes. No, it keeps going up.
Oh, okay.
Yeah,
so
so the longer
incentive to keep working.
Yeah, if you're 70 years old, you're 75, you continue to work, you're putting into assuming you haven't hit the maximum benefit, which you probably have not. It'll keep adding to it.
Excuse me, and the maximum is what?
20.
Well, for someone at full retirement, it's $2,800 a month.
Yeah.
But if you wait till age 70, that's got an increase on it from there. So
30. I think it's like 32 or 30.
Higher than that, I think.
So it goes up.
The estimate was 36 right now.
Okay. Well, then you're probably close to the maximum.
You might be at the max.
Uh-huh.
So then the only increase you'd have was cost of living.
Got it. Okay. That's kind of what I thought, but I wanted to get that validated with someone.
Yep.
Yeah. 30.
And we were as close as you could get.
Right.
All right, Al. Appreciate the call.
Okay. Thank you very
have a
much.
good,
It was very helpful.
Good.
Great.
Enjoy the rest of your weekend. And let's now talk with Steve. Steve, you're with Allworth's Money Matters.
My question is related to the advised three-legged stool for retirement. In my case, I work for the government, so I've got a government pension and then Social Security. And naturally, I'm going to have Social Security reduced from that WEP program. So I'm wondering, would it make sense to use a portion of my IRA funds to fill the balance between what I would normally get from Social Security and what I will probably get from Social Security?
Oh, this is interesting.
Well, I mean, I think the concept behind saving for retirement in your 401k or an IRA is to supplement retirement income.
Which is to turn it into a stream of income. So
Exactly.
Are you asking us, how do you turn it into a stream of income?
Not really how. It's just I know you tend not to favor the annuities, and the pension basically is an annuity.
That's
so
correct.
Wondering, should I take a portion?
We're not opposed to single life annuities or annuities for guaranteed monthly income. We are opposed to these 15-year long equity index annuities that are sold for that have tremendous commissions. So we think the world would be better off if they were never created because they are so misused. Having said that, there are clearly some times when they make sense.
Okay.
So if your question is, does it make sense to purchase a single life annuity or a joint and survivor life for you and a spouse? Is that the question?
Yes.
Okay. So let's look at this. What is and in saying all this, I want you to go to our website, allworthfinancial.com, and anything that says 7 personal decision points, download it, read it, watch it, listen to it. Because it is the retirement planning process that you're going through. but you went to solution before we went to actually determining need. So do you know how much money you're going to need to live on a monthly basis in retirement?
Yeah, we're going to need about $6,500 to $7,000.
Okay, and how much money will your government pension be?
Well, it's defined contribution, so it's sitting. I've got what is that, about $700,000 in 2 IRAs that I've rolled. So that's the two components. My wife also has an IRA, about $300,000.
Okay.
And then we have a joint fund of about $500,000.
Okay, so we've got total assets. We've got $1 million in IRA.
How old are you, Steve?
I'm 67. He's 68 in the fall.
And are you retired now?
Yes.
Okay.
And how much will your Social Security be?
Mine is scheduled at about $1,500, and I think with the WEP they're going to knock it down to about $900.
Okay, and your spouse's?
My spouse at age 70 will be $2,500.
And how old is she now?
She's my age. Yeah, 67.
And where are you receiving? You're both retired. Where's the income coming from now?
We just had some cash set aside to carry us through until age 70.
And when did you retire?
2 years ago.
And that cash you have set aside, is that the same cash that you talked about with that $500,000 earlier?
No, that was set aside. The $500,000 is invested in our joint account. This was just in savings.
So are you taking any money out of your IRAs today?
Not yet.
So what was your taxable income last year?
Oh, last year we were $60,000 combined, just with part times and.
Why aren't you converting some to a Roth?
I'm not real familiar with that on the web.
I'm just looking at.
Okay, so Scott, do you what will your income be this year for 2019?
This year it will be. We might be through small contracts and things, maybe 45 or 50,000.
Okay, so the answer to your question is this: so if you need $65,000 to $7,000 a month to live at age 70, and you have enough money to live until that point in time,
you're fine.
And you have $1.5 million in IRAs and non-qualified. In order to get there, you're going to have to take a distribution of about 2.5% on that $1.5 million in order to get your income to $6,900 a month. Let's call it $700. So you're going to take a 2.5% distribution on the $1.5 million. That in and of itself tells us that you don't need an annuity in any way, shape, or form. Right? So I took that $1.5 million. I took your income from both you and your spouse's Social Security. I looked at $7,000. I took the difference, and that's where I came up with this 2.5%. So the answer is you're fine. You're absolutely fine. You have more than enough assets. You've been invested for a long time. You've gone through a number of market cycles. So you're fine. You can, in fact, increase that distribution to 3.5%, 4% with relative ease at the age of 70, and have monthly income of approaching $9,000 a month. So that's the answer to that question. And look at that as part of the three-legged stool that you talked about. In saying all this, you need to actually, you've got some great planning opportunities between now and then, age 70, that won't exist after age 70. And the first one is that you have the ability to convert some of this IRA to a Roth IRA, or you have the ability to actually just take some of this income out of the IRA and spend it as ordinary income. But what you're doing is your required minimum distribution is going to get to such at age 70, probably for you about age 74, 75, so that you're going to be pushing yourself up and possibly into a higher marginal tax rate. So what we're trying to do is convert the money out of an IRA into a Roth IRA when you're in a low marginal tax rate, and you will lose that opportunity after required minimum distributions are required, obviously. Does that make sense?
Yes. And I've read about the Roths. It seems to make sense. I was just concerned about what will the taxes be, obviously, depending how much, the tax rate will go up. And then how does that affect Medicare? Because I know there's a penalty based on
Yeah,
joint income.
the joint income is about $180,000 before it kicks in. So,
okay.
Yeah, I mean, this is the kind of thing you typically would plan particularly if you're doing some contract work, part-time work, you plan the latter part of the year. November, December, you kind of decide how much should you convert to a Roth.
And you work with a qualified financial advisor, or you're an accountant should be giving you guidance on, has the accountant brought this up?
No, we haven't talked about that.
But you didn't even know about it. The accountant should have brought it up.
The accountant might not even know what he's got in his retirement plans.
That's a good point, Scott.
Okay.
Yeah,
I'll bring that up to him. Yeah, I've wondered about that.
A good financial
about the tax rates and
I mean, I think you'd clearly benefit working with a good certified financial planner. At a minimum, helping you kind of plan through the stuff right now.
Okay.
My opinion.
Quick question before we go. Did someone recommend an annuity to you, or was that of your own?
Oh no, I was just doing reading, and and I kind of figured, well, between Social Security, and we'll make up the difference between just withdrawals from our IRAs and savings. But then I said, well, you'd like to guarantee that income up to a certain level. Say you wanted to reach out of $7,000 a month, you wanted to make sure you had $5,000 a month of that guaranteed or something like that. So
the challenge is interest rates are low right now, correct?
Right.
So it's a great time to get a long-term mortgage for a house.
Yes.
Would you want to be the person loaning
the money for the next 30 years or
at these rates?
Years?
No.
That's what you're doing.
And when you buy it, that's exactly what's happening today. So if you buy a long-term immediate annuity like that, you're buying at super low interest rates for the rest of your life.
And all the insurance company is doing is actually going into the secondary market and purchasing bonds and playing a mortality risk game with your investment dollars and taking a spread or a premium on those because they have same access to the investments that you have. No different. So by the way, you are
good shape.
Financially, you are in great shape. You're able to retire comfortably at age 70. But you would benefit from cleaning up around the edges, some tax benefits that you could be taking care of,
and just some planning. I think you'd probably have more confidence after you've gone through this. But appreciate the call very much, Steve. Well, unfortunately, that is all the time we have today. It's been great being here with you. If you listen to us on a radio program, that's great. If it's a podcast, that's great. If you're thinking about listening to our podcast, go and subscribe to it. We think you'll enjoy it. It's been fantastic being with you. We'll see you next week.
This program has been brought to you by Allworth Financial, a registered investment advisory firm. Any ideas presented during this program are not intended to provide specific financial advice. You should consult your own financial advisor, tax consultant, or estate planning attorney to conduct your own due diligence.